Welcome to FX Talk at eBrew podcast, all about the foreign exchange market. My name is Matthew Ryan, Head of Market Strategy here at eBrew. I'm joined, as always, on the podcast by our Chief Economist, Enrique Diaz-Alvarez, and our Senior Market Analyst, Roman Zaruk. In this week's episode, we discuss whether the recent Sell America trade has run its course. We attempt to unpack the implications of President Trump's tariff deadline and try to figure out what's next for the pound as markets bet on more Labour tax hikes in the autumn. But before all that, we've got something extra special for you today, because we're thrilled to announce that after nearly 5 years of hiding behind our microphones, honing our radio voices and bringing you audio-only episodes, we're finally stepping into the 21st century and have made the leap into video format. Now, don't panic, we'll still be uploading all our episodes to our usual podcast platforms, but you can now catch us in all our visual splendour on eBrew's YouTube channel. So expect some questionable wardrobe choices, the occasional bad hair day, and maybe even a rogue coffee spill or two. Drop us a comment on YouTube and give us your thoughts as to whether this long overdue face reveal is a stroke of genius or maybe just us embarrassing ourselves in high definition. And if you like what you see, please subscribe to our YouTube channel and watch all our future episodes. Can't promise we'll do this forever, but we'll see how we get on. Let's get the ball rolling. We're going to jump into our first segment called In the News, where we run down the main developments in financial markets in the past fortnight or so. Probably the main news story, at least in the foreign exchange market, has been this broad rebound in the US dollar against most of its major peers in the past couple of weeks, which has called into question whether this recent Sell America trade still holds. President Trump's 90-day tariff delay has expired. That expired at the middle of last week, but the deadline for deals to be done has been pushed back by another 3 weeks to the 1st of August. All the while, we've continued to see fresh tariff threats from President Trump. That includes the pledge of 30% tariffs for the EU and Mexico, 25% for the likes of Japan, South Korea, 50% for Brazil and copper imports, among a few others. Meanwhile, economic news out of the US has largely surprised to the upside. That includes the all-important June non-farm payrolls report, which showed another 147,000 net jobs were added last month. That was comfortably above estimates, indeed around about 40,000 more than markets had braced for. This has very much continued to ease fears over a US recession. Markets are now bracing for a pretty solid rebound in the US economy in the second quarter of this year. The big winners in the G10, at least in the last couple of weeks, first of all, have been the Australian dollar, which jumped following a surprise hold from the Reserve Bank of Australia. And then at the other end of the spectrum, we're looking at the likes of the pound, which has broadly underperformed since our last episode amid some disappointing economic news out of the UK, notably another contraction in GDP in May, and the inability of the Labour government to force through its welfare spending bill, which has raised the risk of fresh tax hikes in the autumn. But let's dive into what these headlines mean for markets, because we're going to move on to our next section of the podcast now, which we're going to call the Market Pulse. And now in this segment, we'll pick out some of the main talking points in markets and give our thoughts on what these developments might mean for currencies, the economy, and wider financial markets. Let's start with this apparent easing that we're seeing in the Sell America trade. As we know, the dollar sold off against practically every currency in April following the unveiling of Trump's tariffs. And the dollar indeed suffered its worst start to the year since the 1970s in the first half of 2025. Of late, however, we have seen a little bit of a shift in the market's view towards these tariffs, whereby the threat of greater trade restrictions now seems to be accompanied by a stronger greenback rather than a weaker one. So I'm going to hand over to you, Enrique. Is this Sell America trade a thing of the past? And if so, why are we seeing this shift in market's view towards the dollar?
I mean, undoubtedly, I think the Sell America trade, that terrifying few days where we saw markets selling down the US dollar, the US Treasury bonds and equities all at the same time, is over and has been over for a while, and we're returning to the more habitual patterns. I think there's three things three factors that are driving the end of the Sell America trade. One is, first of all, the U.S. dollar has corrected by a full 10%. It's like you said, the worst start of the year since Nixon cut the ties between the dollar and the gold standard in 1973. A massive sell-off. Second, Trump, the taco trade. Trump always chickens out. We have Trump is clearly finding it very difficult to withstand significant sell-offs in this equity market as a result of his policy announcements. That's why we keep seeing this bombastic announcements about tariffs, always announced with a few-week delay, and once the deadline comes, they get postponed. Let's remember that all these letters that he sent out, what they amounted to was a postponement of the July 9th 90-day deadline that he gave on April 9th. And those are the factors that lead me to believe that the markets are reverting to additional patterns, to their previous patterns. To me, the critical indicator here is the performance of U.S. equities versus the rest of the world. We had from 2012 to just Liberation Date a consistent pattern of massive outperformance of U.S. stocks as funds from the rest of the world pour into the U.S. to participate in the rally. That trend reversed clearly around Liberation Date, and there was a meaningful drop. And we have reversed again. U.S. equities are outperforming the rest of the world, even taking into account the currency movements. So yeah, that's the apocalyptic vision that people had, that some of us were worried about in April.
I really like that term, the taco trade. I'm not quite sure who came up with this, but it's something that's been in the headlines recently.
Trump must absolutely hate, given his shall we say personality, to become part of an acronym that Trump always chickens out. Maybe at some point we'll see a counter reaction from him, but we have not seen it yet.
Maybe because of this acronym, he's threatening higher tariffs right now.
Quite possible.
Yeah, he's not imposing it. It's always the same. It's always higher tariffs X weeks from now. That's what the market's playing, at least. That's why equities continue to hit record highs.
Well, that's the thing, isn't it? I mean, this is what we were talking about even back in November. If you remember, the first term of President Trump, this was what he was known for, wasn't it? It was, big bombastic statements, lots of bluster. Actually, his bargain is worse than his bite, and maybe we're going to see that again this time. At least it seems as though that's the case. Anyway, I think the big surprise here really is how resilient the U.S. economy is proving. Businesses in America, or business owners, I should say, don't seem to be too bothered by the tariffs. The non-farm payrolls data, in particular, for June was very strong. The PMIs have been solid. As I was saying, the growth in the second quarter looks like it's rebound at a decent pace. Do you think this trend of strong US data can continue, Enrique? And what sort of data are you mainly looking at here? Are you mostly looking at the labour market? Is that where we might start seeing maybe a bit of weakness in response to these tariffs?
I am a very boring guy. I've been looking for 25 years of jobless claims. It's clean. There's no surveys, actual data coming from the U.S. Labor Department. People who lose their jobs and need to file for unemployment benefits right away. It's not going anywhere. It's low, much lower than it has been historically. It's not going up. Every once in a while you have a head fake when it seems that it's trending up, only to come back down again. The U.S. is at full employment. I think this is a significant change in the economic structure of the U.S., maybe driven by demographics and the aging of the population. I wouldn't say there's a structural shortage of labor, but we're almost at that point. And as long as everybody who wants a job can find one, which is, to me, is clearly the situation now and has been for many years, the U.S. economy will have no problem chugging along at 2%. I will mention that the last real recession happened, 15 years ago, over 15 years ago. The COVID is obviously a very different animal. It's the longest I think we've been without major retrenchment by businesses in hiring since basically forever, since the history of capitalism. And I think that there's been some structural changes, probably demographic, which means that the economy is much more resilient, demand is much more resilient, and perhaps the worry will be going forward inflation and the deficit rather than the business cycle and unemployment. I know
I
Roman.
like how the US itself it determines itself when a recession has occurred. Everywhere else it's two consecutive quarters of negative economic growth. In the US, we'll decide when the US is a recession, not the rest of the world.
Yeah, it's like Trump deciding when the 90-day deadline ends. It's not the actual time. But Enrique, you say that the U.S. job market is all fine, but not all indicators are that rosy. I mean, if you look at, for instance, the job openings and the whole package of data that is inside that report, it confirms that there are not as many job openings as you had. So if you look at some other numbers, some details of the PMI releases, for instance, etc., they're kind of you can get this feeling that maybe it's not terrible, but that there has been some deterioration, and that this market can be defined as basically a slow to fire, but also slow to hire. So
No,
it's
I
not that.
agree that we're
Yeah.
not seeing the absolute hiring frenzy that we saw in 2022. But first of all, I would discount somewhat those job opening data and PMI because they are surveys and they're affected by, for instance, the fact that companies are posting ads in different ways. I am a fan of hard data. I'm a fan of establishment reporting how many people they have on their payroll to the Bureau of Labor Statistics. And most importantly, I mean, there's people who do not have a job or who get laid off from a job and cannot find another one right away in this country, everywhere, will file immediately for unemployment benefits. You get that data point every single week. It's going nowhere. There's no significant deterioration in the labor market that I can see. Again, granted that we're not at the frenzied levels that we saw a year ago or a year or two ago. I see no signs of slowdown. And tariffs, well, it's not this. Imports account for what, 10, 12% of the US economy. It's an unusually self-contained economy. So I think that even the disruption and damage that they will do, and they will do some, I mean, tariffs have quadrupled or quintuple since Trump took over office. The worst projections have not been realized, but we still have higher tariffs that we've had in many, many decades. But still, we're talking about 10, 12% of the US economy. And clearly, they're not really causing significant disruption.
No. I mean, it seems as though the market and business owners are coming around to that conclusion that actually, the tariffs are not going to be quite as bad news for the US economy as thought, certainly at the beginning of April. So that's been good news for the dollar. And just quickly, I mean, we've got the Fed July meeting coming up, I think in a couple of weeks' time, end of July. Cut pretty much off the table. What do we think? And September now looks a little bit in doubt as well. I mean, do we even expect a cut in September? Could the Fed wait a little bit longer? What do you think?
It's a very difficult call because it's so data dependent. I think that in today's inflation number, we saw perhaps the beginning of the first impact of the tariffs, which was offset by an unusual drop in car prices that was driven by domestic factors. The markets are pricing in roughly a 50% chance of a September cut. I still think that my structural view is, like I said, that we're in a different economy. Inflation over the medium and long term is more likely to surprise to the upside than to the downside. We're going to get worse numbers than probably markets are expecting in inflation between now and September, and that will both shut Trump up in his pressure on Powell and give the Federal Reserve the opening to keep rates steady. I mean, rates are not high. Rates are at less than 4.5%. With the economy growing around 2% and inflation still north of 3%, this is not a restrictive monetary policy. So my guess is no cut in September, but I admit that this is a weakly held opinion because a lot depends on the data points between now and then.
Yeah, on the data points, but also on the trade deals, because I think that the biggest issue, or one of the two big issues that the Fed has right now, is just the uncertainty about the impact of tariffs on prices, whether it's going to be a one-off impact or if it's going to be something that gets ingrained in the economy, in
That's a
people's
fair
minds,
comment.
etc. So
That's fair.
yeah, and
Yeah.
we have the deadline on August 1st, so we'll have to see whether those deals are made, whether the trade uncertainty eases. But in this context, I could see the cut being delayed. Although still, I think that there is enough easing in labor market data, and there's enough downside surprises in core inflation data. I mean, we had 5 months of downside core CPI surprises, and this is something. So based off that, I would still think that the cut is likely, but yeah, a lot will probably depend on those deals and how it affects inflation.
One fact that I also will add is that going forward, we may have relatively less attention being paid to tariffs and more attention to the impact of the budget bill on the U.S. deficit, which are due to stay extraordinarily high, 6-7% projections as far as I can see, absolutely unprecedented in a time of full employment. The U.S. Treasury market, I will note that the long end of the market, the 20-year, the 30-year, has done nothing but sell off since the bill was passed. It's hard to predict what impact this will have in the US dollar. On the one hand, higher rates normally in the US normally attract buyers to the dollar. On the other hand, the fact that this is higher rates are not driven by economic outperformance, they're driven more by risk premium being added to the long end of the Treasury curve may counteract that. But I can see a world over the next 3 months in which we're paying less attention to tariffs and more attention to where the 30-year Treasury is trading.
Yeah, no, I agree.
We had good inflation numbers, rallied for a while, back down for the day again today. The Treasury market.
Yeah.
It's it's an orderly sell-off, but a very steady sell-off.
Yeah, it does feel as though that will be the big focus. The second half of this year as maybe fears surrounding the tariffs die down a little bit. Let's see how these trade negotiations go in the next couple of weeks. But if some deals are done, particularly with the European Union, then certainly I think the topic of US debt and yields, is very much back in the forefront again. Let's move on now. I want to talk about Trump's tariffs in a little bit more detail because, as we know, the initial deadline for these tariffs was the 9th of July. That was last week. But the president has once again pushed back the deadline for deals to be done by another 3 weeks to the 1st of August to allow time for negotiations. The big question is what happens after the 1st of August? Roman, what can we expect once the 1st of August rolls around? Will we get some deals? Will we see more delays? And how might markets react? What do you think?
Okay, so I think it's very much a case-by-case basis with trade negotiations and the deal process. I think the general feeling is that there are going to be trade agreements in the coming months, that we are getting close in terms of agreements for many countries. But whether it's going to come around as soon as before the August 1st is anyone's guess. I mean, trade negotiations are known to be tough, and Trump has decided to ramp up pressure on a number of countries recently, including the EU, with a threat of a 30% tariff. And I think that both the US and the EU have significant incentives to agree on a deal. Of course, the EU is said to be in a weaker position here because it's a very open economy where export plays a much larger role relative to the US. It's more than 50% of GDP versus about 10% for the US. And also exports to the US at about 20% are higher than US exports to the EU, about double. Looking at the percentage differences. But still, the EU is a large consumer market for US products. The EU market is very important for the US digital services. So both sides have something to lose. And because of that, both sides have a strong incentive to negotiate. And recently we had some positive comments on both sides of the Atlantic, although, as you know, Trump soon after threatened the EU with this 30% tariff. So this was met with a sour reception, and the EU threatened countermeasures. So it's really difficult to say what will happen on August 1st. Trump may, if the deals are not agreed on, Trump may go an amicable route. So perhaps if he sees that a country is negotiating in a good faith, if there is some progress being made, then maybe he will delay the imposition of the larger tariffs. Or maybe because he would want to save face, maybe he would impose harsh tariffs. But still, I don't think that markets are expecting that very high tariffs will be in place for a very long. The general impact of tariff headlines on markets noticeably decreased, and even if we see a significant deterioration in the situation, even if Trump imposes high tariffs on August 1st, I would still expect the volatility to be relatively contained. Of course higher, but not massively higher. And it's a very interesting topic with what's going to happen to the US dollar and to the currencies in general, because as we know, after the April 2nd, the US dollar has felt the pain, which was counterintuitive because everybody expected the US dollar to be stronger. This was in line with standard economic theory. But right now, it seems that there has been some reversal with regards to how the dollar is reacting to those tariff headlines. So if countries see high tariffs, if emerging markets particularly, I would expect those currencies to sell off and the US dollar perhaps to be a bit stronger.
Well, that's a good point, really. I mean, how's the dollar going to react to these tariffs? If we do get higher tariffs on August the 1st, are we going to see what we saw post-Liberation Day, i.e. weaker dollar, or has the dollar sort of regained its safe haven status to an extent that now these tariffs are back to sort of conventional way of thinking, whereby higher tariffs means a stronger US dollar? That's going to be interesting. What about China? Because
there's been a bit of a reversal in the way the dollar reacts to this tariff announcement. You saw it in the announcement of that 35% tariff on Canada. The Canadian dollar sold off, which is the theoretically correct reaction would be for the dollar to go up on tariff announcements, but after Liberation Day we had the opposite. So it's interesting that we're reverting slowly to the old correlations and reactions in the currency market.
Yeah, that was always the way, wasn't it? Pre-Liberation Day, higher tariffs, higher market uncertainty, prospect of weaker growth, good for the dollar. It's only since April 2nd that's not held.
Yeah, because two things change. One thing is that markets do not expect the US economy to feel as much of an impact of those tariffs. So this is important. And in general, I think that markets are not afraid of tariffs as much because they don't see them staying high for very long. In many countries, in the context of many countries, we probably are going to look at relatively low rates relative to what we saw on April 2nd.
Great. I wanted to move, just quickly touch on the pound, because sterling has underperformed most of its peers in the last couple of weeks or so amid concerns over the UK's public finances. The big news perhaps was that the UK government, the Labour government, was unable to force through welfare spending cuts earlier this month. If you combine that with some pretty weak data, we look at data out of the labour market in Britain, May saw the largest drop in payroll employees on record outside of the pandemic period. The latest GDP data was disappointing again. The UK economy contracted for the second straight month in May. The problem here being that weaker growth, higher UK bond yields, which is the cost of the government's to finance its debt, an inability to cut spending means that the government's given itself very little wiggle room to balance the books, and that fiscal headroom that the government has given itself has been eroded quite significantly in the last few weeks. What that means is that markets are pricing in a higher chance of tax hikes. The government has two options. It can either cut spending or it can hike taxes. If they're unable to force through welfare spending cuts, it looks as though that tax hikes are on the horizon. So what does this mean for sterling? Well, look, I think we've had a pretty bullish view on the pound so far this year. You know, the UK isolated from the tariffs. The Bank of England likely to cut rates pretty gradually, we think. The Labour government's pushing Britain closer to the European Union, but this puts a little bit of a dampener on that view. You know, let's see how we get on the next. Yeah, over to you, Enrique. I mean, what are your thoughts on this?
It's true that, I mean, we've had a bullish view. On the other hand, that bullish view has been largely realized. Sterling has performed very well so far this year, especially versus the dollar. And I think that I go back to my thinking that we're going to be paying much more attention going forward to demographics, pensions, finance, and the sustainability of public finances, not just in the US. And I think sterling is perhaps, the UK is the canary in the coal mine here, because it has higher dependence than most countries on foreign investors, most major economies, on foreign investors to finance its trade deficits and its public debt. And I think that the latest numbers, especially employment numbers, are really quite worrisome in the sense that the UK seems to have reached the point in which additional tax hikes are actually worsen the public finances because they slow down the economy and job creation more than they bring in revenue. And that combined with the political inability to cut any spending at all is quite worrisome. We're seeing quite a reaction in the long end of the bond of the yield curve, and we're starting to see a bit of a reaction in that direction in sterling. So I think that I'm no longer bullish on sterling. I think that right around here is probably fairly priced.
That's interesting. I mean, I'm not quite as negative as you are, but I think certainly my optimistic view on the currency is faded a little bit. You know, I think the labour data we've had in particular has been far worse than I expected. And I did think that these tax hikes would start feeding the way through to weaker labour market performance, but you know, the concern is that it's just started and we're just seeing the extent of the downturn in the jobs market, and if it gets worse from here, you know, we're staring down the barrel of possibly, you know, dare I say it, a recession this year, because the growth data we've had the last couple of months has been very poor, and you know, if the labour
varies on the UK economy, because I still think that the dynamics where demographics make it difficult for the unemployment rate to go up every year. There's more and more retirees, people with disability, etc., and fewer workers. Those dynamics make it very difficult to get a recession like we used to have in the 80s and 90s, well, more difficult. But I still think that on the margin, the tax increases no longer seem to have significant impact on the improvement of public finances, and that's a worrisome point to be in. Again, I'm not turning bearish. I wouldn't sell short the sterling, especially given the increase in interest rate protection that the currency has as yields go higher, but I would not be long the currency either.
Definitely less optimism right now about the UK. I mean, looking at the data, but also I think particularly looking at the political landscape, I think that the fact that the mainstream parties are seeing very low support, they are in a very difficult place right now in the British Parliament with regards to the fiscal situation. It seems that there are many issues that the country has that are not addressed or that are addressed in a suboptimal way, and this all just adds to the fiscal strain. And I think that yes, the recession risk or a slowdown is certainly important, but if we were to see some really big blow up in the debt globally, then probably the UK would be one of the major countries that would be thought of as the one being hit. Not saying that it's going to happen. It's of course something of a tail risk and something that would be probably unthinkable a while ago. But if something really happens, then probably I would be the most worried about the UK, or it would be one of the top 3 countries.
Yeah, so certainly something worth monitoring in the next few months or so. We're going to bring back a popular segment of the podcast now, where we each pick a currency and give our thoughts on whether we buy, sell, or hold that currency. We're gonna start with the Australian dollar. Currency has performed pretty well in the last couple of weeks after the Reserve Bank of Australia unexpectedly held policy steady at its last meeting after investors were almost fully pricing in a 25 basis point cut. But is it now a good time to buy? What do you guys think? Buy, sell, or hold, and a very short rationale. I'm conscious of time, so very short rationale as to whether you buy, sell, or hold the Australian dollar.
I would hold, but mostly it's a US dollar trade and an Australian dollar trade. I think that we're in the middle of a apparent transition from tariffs bad for US dollar to tariffs good for US dollar and bad for everyone else. I think that we need to monitor that transition a little further because it is not clear that it has happened completely. So for now, I would hold and see where tariffs go, and more importantly, where the dollar's reaction to tariff announcement goes.
I thought everybody would say buy, and I wanted to say hold actually. So for me, it would be a hold because the China concerns proved not to be as high as some have been worried about, and the RBA held off cutting rates recently. But at the same time, if you look at economic data, it's not terrific, and I think multiple rate cuts are on the way. And in general, I'm not as comfortable with the region, so I would not buy, but also I would not sell considering it is relatively cheap.
I'm going to be bold then. I'm going to say buy. I mean, it's not a strong buy. It's probably a mild buy, but it's still a buy nonetheless. I mean, I do think this RBA shift it's not a big change for the currency. I think it's mostly kicking the can down the road, and I think they'll still cut rates probably at the next meeting, at least given the tone of the communications. But this focus more on inflation than growth in the RBA's communications tends to suggest to me that maybe they won't lower rates as much as what markets had expected. And then you mentioned the lower impact of the tariffs. If the US and China come to some sort of a deal, which I'm pretty hopeful they will, that will avoid higher tariffs, that should be good news for the Australian dollar. It's effectively a proxy for CNY, so any sort of optimism over China is good news for the Aussie dollar. And then look at the domestic economic situation. The labour market in Australia is still holding up pretty well. The growth outlook is relatively favourable. It's certainly more favourable than the neighbouring New Zealand. So I'm going to be bold. I'm going to go for a buy for the Aussie dollar, even if it's not necessarily a very strong one. Fantastic. Let's finish by looking ahead to the next couple of weeks or so, and we'll finish with this segment we're going to call the FX Radar, where we look ahead at what we can expect in markets in the next few days and the next couple of weeks. So chaps, what's on the horizon in markets? What are you going to be keeping tabs on between now and our next episode? Roman, maybe we'll start with you. What are you going to be focusing on the most in the next couple of weeks?
Okay, so I'll focus on three things: tariffs, and tariffs. And this is going to be particularly important considering the August 1st deadline. I'm especially interested in the Asia region, considering how the structure of the deal with Vietnam looked like. And effectively, the structure means that the Trump administration is concerned about transshipping from China, and this also kind of serves as a blueprint for other countries. So how those deals with Thailand, with other countries will look like will be important for me, considering the Asian region, but also headlines with regards to the EU deal. This is important for all of us, also in Central Europe.
I think it's a bit of a silly question, really. I mean, it is all about tariffs. I think that's going to be absolutely key. Aside from that, I mean, I think once all this, if we do start getting some deals done, I think attention will shift back to the Fed. It's as to what extent is the Fed still, are they concerned about these tariffs still, or is the focus on inflation? If that's the case, then we could see a more gradual pace of cuts. Maybe September's off the table. I think that's going to be the main focus for me outside of the tariffs is, what does the Fed think? Is it still going to cut rates September, or are we looking a little bit later in the year? That's going to be important. Enrique, any thoughts? What are you looking forward to in the next couple of weeks?
Frankly, the next couple of weeks I expect to be a little bit quiet because there's none of the data that really move markets, either employment or inflation in the US. We just had inflation today. And I don't think anything will be resolved in the next 2 weeks. So we're going to have an unusual quiet period, I think, in the markets. It's my view.
Let's see. I mean, whenever we think that, generally that's not the case, and something comes around the corner to surprise us. So that may.
Holidays.
Yeah. Excellent. Thank you both for joining. I think we'll wrap things up there then. And thank you all for joining the episode today. I hope you enjoyed, whether you're watching it or listening to it. So yeah, thank you again, and we'll catch you on the next one.